when I look at stocks like Peloton and I look at Zoom and I look at Amazon and I look at Domino's Pizza, what I see are stocks that have already passed their peak. Now, I'm not saying that these stocks can't recover and go back up. Maybe they're just taking a pause that refreshes. That certainly could be very possible. All right. But let's take a look at the first one. The stock you're looking at is Domino's Pizza, DPZ. The stock was at 435. You see that 52-week range. Okay. So it was at 435 and it's now 386. That's like a $43 stock going to 38. Not a disaster from where the stock has come from. But if you take a look, that is a pretty steep retreat from its previous high. Take a look at Amazon. Amazon is the granddaddy, the absolute granddaddy of the pandemic stocks. And that stock was $3,552, and now it's 3,100 and change. So it's like a $35 stock going to 31. And you could see here where the high was. All right. And that high was around early September. And ever since then, the stock is coming off. And that's a pretty good percentage to go down. Okay. It's over 10% drop from its high. And what I see happening consistently with these stocks is that they have all peaked somewhere early September, and then the stocks have backed off. So this is Zoom. The high on the stock was recently 588, and that was October, and the stock now is 412. So from 600 almost to 400, stock lost almost a third of its value. Do you see the pattern I'm talking about here? But let's take a look at Peloton. That's another quintessential stay-at-home tech-related stock, even though it's in the fitness industry. That stock has had a little bit of range of 139 to 118. So that, let's say it's like a $14 stock going down to a little under 12. Not a disaster if you have the stock really low, but now you have to start wondering, is that stock going to recover, or did it see its best days? And I just want to give you a view of where the money is going. This is the XLI. This is the industrial stocks, the big industrial stocks exchange traded fund. And that is bumping right along its all-time high. It's less than $1 off its high. So this kind of speaks to the rotation that's taking place, where money is moving from these work from home, stay at home tech related stocks, moving into industrials and other economically sensitive stocks. I'm not saying that this is an alarm bell that I'm sounding off, but what I am saying is, if you made a lot of money in these stocks, and these stocks have clearly, at least over the near term, have made a peak, you have to consider what could get these stocks to a new peak. And because these stocks had such substantial runs from last June through September and October of this year, it's easy for me to envision that anybody who would have, could have, or should have bought these stocks have bought them. And the people who bought them in the last month and a half are totally Johnny-come-lately, performance-chasing investors who are now sitting in down stocks. They don't want to sell them because they just bought them and think, oh, these are going to go right back up. But if I was a holder of these stocks already, and some of them I am, but if you're a holder, if you're a long-term holder and you don't care, then none of this matters. But if you're buying these stocks to make money over the near term, short-term profits trading, you have to think that other people who have these stocks lower are not going to want to give back their gains in these stocks. So that creates a race to the exits to sell these stocks. And from the charts, the way they look now, that's what it looks like to me. So buyer beware.